Good afternoon. This is Michael from Scottsdale, Arizona, and it's been a while since we've spoken. I've had such great holidays. It's time to get back to work, and I'm back to work with a vengeance, doing an awful lot of business. We have an awful lot of people repositioning their portfolios, so we're extremely busy. I need to get my disclosures out. I am not a licensed stock and bond broker, nor am I a financial planner, although I am very familiar with an awful lot of the other asset classes and an awful lot of what they're doing. I follow them. I'm a syndicated columnist with the Wall Street Greeks, so we get an awful lot of research sent to us, so I'm pretty current as to what's going on. And for the last year, and I think it's almost a year since we started talking about this, we've been looking forward. Keep in mind, we're always looking forward 4 or 5 years. But we've been looking forward, saying that we have trouble coming, and it's time to start taking some money off the table. Now, in 2013, 2014, we started winnowing our real estate portfolio, getting rid of anything that was a marginal property, going to cash. And for the last 6 months to a year, we've been talking about taking money out of the stock and bond market because risk is rising significantly, exponentially. Not only in the stock market, you can see where you have a profit recession, where an awful lot of these are profits are not rising anymore, and the prospect for more buyouts by the individual companies is slowing down significantly. So we're not going to have a boost in the PE because we're buying back shares, and revenues are coming down. Retail has been awful. So these are all harbingers of things to come. And actually the federal chief of the Federal Reserve, Dallas Fisher, came out this week saying that he was party to the bringing the stock market up, and to forcing it up, trying to get a wealth effect, and that they kept raising and buying stocks and buying bonds, and now they have a debt of almost $4 trillion. And he says that the Federal Reserve is out of ammunition, and they're raising interest rates. They're raising interest rates, ladies and gentlemen, because they want to be able to reduce them when things get really bad. Anyway, they're kind of in a trick bag, and the economy is going to falter at this time. So you just need to be careful at this. There's nothing to be afraid of. I mean, this just happens. You just need to prepare for it. Listen, we've had 5 or 6 bad recessions in my lifetime. This will be another 7th. We'll get through it. So 18 to 24 months from now, we are going to have the greatest real estate market in my lifetime. So I'm preparing for that, and there'll also be some other things that we can be buying at that time. If it's outside my province, I'll tell you what I'm going to be buying is some oil. I think that'd be a great buy. Oil and gas and natural resources will be terrific, but not yet. So in the meantime, I have been pounding the table, saying, look, you have risk coming, and to reduce that risk, you should be paring down your stock and bond portfolio. Now, in the last 4 or 5 days, I think we're down almost 1,000 points on the Dow. I think we were down 430, 440 points today. I don't think we closed quite that bad. I think it's pretty close to 400 down. Probably going to be a bounce pretty soon, but it's just a bounce. Keep in mind the direction of the market is down. So if you get a bounce, you should be being very cognizant. This is your money. You should be taking that money and removing it from the stock market. You should already have talked to your financial advisor about an exit strategy, and say, at what point do we remove some of this money in case this is not just a little correction. Looking around the world, I don't know where the robust economic activity is going to come from. Typically what happens is that we have a recession. It clears all the debt, clears all the old companies, clears all the things that were malinvested. They go away. Things get pretty rocky, and then things get better. And we're looking 18 to 24 months. This is a very old recession, recession recovery, and it's slowing down. So if you look at China, China's in a world of hurt. And look what happened in the last 4 or 5 days with the Shanghai index. They put in circuit breakers that stopped the market at 7%. And today, Thursday, January 7th, Shanghai opened, and within 15 minutes, they were already over 7% down. I don't think they made 15 minutes, and it shut down the market for the whole day. So that's happened 3 times in the last 4 trading sessions. So this is just not a good sign. So this is happening all around the world. There's a lot of risk in the stock market of the world, and I'm going to tell you there's a lot of risk in bonds. If you're in the high yield bonds, you have really taken a lot more risk than I think most people understand. High yield bonds, there's like $7 trillion in high yield bonds, and I think about 3.5 of those went to producers of oil and the shale and gas fields of Nebraska and the Dakotas. And of course, we all know what's happening with that. With oil is down in the 30s. I think it even dropped today. I think it's around $33 a barrel. It makes those producers insolvent, and they probably will not be able to pay their bonds, in which case you're going to have a pretty bloody default cycle in those high yields. And of course, that's going to bleed over to other corporate bonds, and you're going to see rate increases on this, because when risk rises in a bond field, don't forget it's not just inflation. When risk rises, interest rates rise, and of course, if the corporates look like their economy is slowing down and their business is slowing down, lenders want to get compensated for the risk that they run. So I'm anticipating interest rates to rise. Interest rates rise just on a natural basis of interest rates rising, not talking about defaults, just interest rates rising, bonds get killed. And if you're holding bonds, which are considered the widow's and orphan investment because it's supposed to be so conservative, I'm going to tell you, you'll have your head handed to you. So you really need to take a look at this and look at municipals. So these are another conservative play. Munis are going to get massacred. Look at Puerto Rico. That, for all practical purposes, it's bankrupt. Illinois, bankrupt. Chicago, bankrupt. California, bankrupt. And you go on and on and on. Just an awful lot of these places. Politicians overspend what they get. If they get $1,000, they want to spend $12. It's just that's just the way they are. They want to pander to their clientele and enrich everyone. Well, it gets to the point where you can't borrow anymore, and that's where we're at. I mean, government's no different than a household. I mean, if you make $100,000 and you've got $90,000 in interest burden, believe me, you're not going to get any more debt, and that's where the governments are at. So. And when that happens, they start to default because they just can't pay. They can't pay. You have defaults, so you're going to have defaults in munis. You're going to have defaults in the high yields. Going to spill over to the corporates, and you're going to see some things happening in this sovereign debt around the world. U.S. Probably is going to get stronger. And believe me, if you were a Ukrainian businessman or a French businessman or a Brazilian and you want to get money out of your country, where are you going to take it? You're not going to take it to Russia. You're not going to take it to China. You're going to bring it here. So you're probably going to see the dollar get stronger. As the dollar gets stronger, it's just like a paradox. The stronger the dollar gets, the worse the other currencies of the world get. The worse their currencies, their economies get. And keep in mind, there was $10 trillion worth of debt in the last 4 or 5 years taken out in dollars, because the dollar was dropping like a rock, and no one ever thought that the U.S. dollar was going to strengthen. Here it is, the dollar strengthened a lot. So not only do they have to pay back in dollars, they have to pay back in stronger dollars. So they probably added 20 or 30% to their debt. So instead of them owing $10 trillion, now it's going to be like owing $13 trillion to countries that are really struggling. So you can just consider the fact that, very similar to like the 1997 Asian currency problem, we're looking at that, and that's going to come. So I'm telling you that the risk is rising. So what are you going to do? If you put it into cash, you can put it into money markets. Don't forget that just recently the money markets no longer have to honor the dollar per share rule that was just changed. So they broke the buck, and that may impact. I don't think it'd be terribly significant, but you put $1 and you may only get 97 or 98 cents back. I mean, that's possible. You're not going to get any interest, that's for sure. The banks, it should be safe up to $250,000 per account. Keep in mind, there's talk on the street that you may not be able to get your money when you want it. Now, I don't know this for a fact, but that's certainly part of one of the problems that we're looking around in the world. So, certainly want to keep some money in the stock market. But what I'm going to suggest, and this is a little self-serving, so yes, it is self-serving, but I think it's also in your best interest to do this, is to find a real estate market that still has cash flow and still has potential. There's several around the country that are really, really good. Orlando, Florida, as bad as the things, I think Orlando's still good. Places in some in Texas, Houston used to be good, but they're going to be impacted a lot with oil. Same with Dallas. Long-term, Dallas is just going to be great. Las Vegas has good potential, and I'm going to tell you, here's my home market is Phoenix. We're just doing really, really well. Forbes has us the number one or number two market in the United States for the next 10 years. Same with job growth. The jobs growth has been very, very well, and principally because California is going to do so poorly. We're going to get an awful lot of people who are abandoning California, coming here, and we're going to just see population grow because we're still an affordable marketplace. We just had Amazon warehouse open up here, and they advertise for warehouse workers to say, look, you don't necessarily have to have a college degree. You don't even need to have a high school degree. Come work in our warehouse. They pay $10, $12, $14, $15 an hour, but it's not livable in California. $12 or $15 an hour is much more affordable, much more livable here in Phoenix, Arizona, because our housing is so much more affordable, and our living expenses are so much more affordable. They open up here, and that, of course, is what's going to happen in California. You're going to have an awful lot of people come here. It's just because we're a right-to-work state. We're a very pro-business state. We have very, very good budget controls on our fiscal. We've been very, very fiscally responsible. So Phoenix is going to do really, really well. I mean, not to beat my horn and or beat my drum and ring my horn, but that's probably what's going to happen, is that we're going to do extremely well. We can buy properties here that actually cash flow. You're going to get a monthly income from those. So if you take the money and I think the risks, you look if the economy drops, I think we're going to have a correction and ongoing bull market in real estate in the United States. Here in Phoenix, I think it's just an unbelievably good place to be investing. Yes, rents could go down 10 or 15%, in which case we're going to lose some of that cash flow, but I think it's going to be reasonably safe. So we're certainly much more less risky than we would be in the stock and bond markets. I don't believe we have a bubble here in Phoenix. Some bubbles around the nation. I wouldn't be buying anything in Silicon Valley or San Francisco or Seattle or New York. I'd have to look really, really hard at those, see if those are any good, but because I don't want to label them just because they've got some problems. But here in Phoenix, I don't think we do, and I think there's still room for growth. Certainly in the outlying years of 2018, 2019, 2021, I think we're going to do exceptionally well. So I think your money, not only is it going to be fairly safe here, and I think it's going to be some asset preservation. And I think the risk is far less here in Phoenix real estate than in the markets, particularly in stock and bond markets. I just think it's not the place to be. And if you're going to come out of there, there's relatively few places that are going to be safe. And I hate to use that word safe because I do think we're going to have a correction in prices. So I've advocated that you take 50 to 75% of your money out of the stock market, try and get it safe into cash or short-term treasuries, and then to deploy half into cash flowing real estate. And we are so terribly conservative at the moment. We're looking really at single-family homes, which are so conservative. Financing is just so compelling, and they're so easy to rent. We're trying to preserve your assets. We're not saying that you should take money out of your savings account to do this. We're saying you should shift your assets. So if you have money in stocks and bonds, you should just do an asset allocation. And at this point, we want some asset preservation. Because I think that investing here in Phoenix or investing in your hometown and just taking a look at, you're always welcome to call me and we can discuss what it is that you're thinking. But here we're all set up for you. I mean, you'll be the investor. We have management companies. We can manage the property, collect the money, take care of all the problems, and send you a check each and every month. You'll never meet your tenant. I even have investors that have never seen their houses. They just get a check every month. So we can certainly do that for you. I mean, it's a pitch for myself. I'd love to have your business, but we are really, really, really concerned about what's going to be happening in the economy. I think we have a bounce coming. We've taken 3 or 4 days of just brutal downside. We're probably well oversold here, so wouldn't be a bit surprised to see we lost 1,000 points to get a 300 or 400 point bounce, maybe more. At that time, I looked really, really hard at my portfolio, but my opinion is that the direction of the stock market is down, and I think interest rates are heading high. I have several. Walter Zimmerman thinks interest rates are heading up, and Charles Nenner also thinks interest rate. People just don't get that, but as risk goes up, interest rates go up to compensate for that risk factor. So I think that puts the bonds in jeopardy as well, not only just economically, but also because of rate risk. So listen, this is Michael Douville. I am in beautiful Scottsdale, Arizona, and you are welcome to call me at any time and let me know what your thoughts are. My very, very best to you all. Bye-bye now.